And we're going to talk again inflation. Thing number one, Gary, the Fed cuts again and increases inflation projections. Oh no.
You know, Rob, I got to tell you, we're rolling into 2025 here, and I am desperately hoping that we will not be talking about the Federal Reserve every week. Every week, I keep trying to not talk about the Fed, and every week they keep doing the same thing. So here we are. Last week, the Federal Reserve completed its final meeting of the year, and as expected, surprising nobody, they cut the Fed funds rate by 25 basis points. The current reference rate is, depending on whether you're buying or selling, borrowing, or lending, is 4.25% to 4.5%. For those of you who were keeping score, that is a total of 100 basis points or 1% cut since September. That's obviously going to be the final cut of the year. Now, their press release, while acknowledging we've got an uncertain employment situation, which we've talked about constantly on deep knowledge investing, the only reason we've had any kind of employment growth is because the government has been buying it. It's all the growth has been in government jobs. But the press release also commented, ready for this one, on elevated inflation and expanding economic activity. Exactly the thing that you don't cut rates into unless you want more inflation. So the Fed is saying that they've achieved a balance in trying to reduce inflation and maintain high employment. My view is that's not right. I think inflation is too high. And the only reason the employment situation isn't a disaster is because of additional government stimulus. So basically, what the Fed was saying is, yeah, we've got a lot of stimulus and too much inflation and expanding economic activity, so we're going to cut rates. That makes no sense at all. I also think it's notable that Beth Hammack voted against the 25 basis point rate cut. The reason that matters is the Federal Reserve almost always does everything unanimously. So the fact that there was somebody openly dissenting, saying, no, we shouldn't be cutting, was pretty interesting. But Rob, all of the interest and the reason the market went down hard that day and the next day is precisely because of the dot plot. Now, for people who don't do this all day, every day, the dot plot comes out a few times a year. I think it's 4 times a year. And what each Federal Reserve governor does is they put their estimate for where they think the Fed funds rate will be at the end of this year, the end of next year, the end of the following year, and a long-term number. And so when you look at that, a couple of things come to mind. One is the Federal Reserve is never accurate with this stuff. Their own projections are horrendous. And, Andrew Brown, former intern, he and I did some really interesting work on that and realized the Fed has no idea what they're going to do, even with the thing that they control. But the other thing is the ranges are very, very wide. And you'd be amazed that, the Federal Reserve, you've got people voting or putting dots on the plot that could be 1% apart or 2% apart. At any rate, the big news is that even though the Fed cut, they increased their estimate for future inflation and decreased their estimated number of future rate cuts. So to give you an example, after the last dot plot, the Federal Reserve was saying, we think we're going to cut 100 basis points or 1% in 2025. That's already been cut in half. The 2026 number, that got cut as well. That estimate rose from 2.9% to 3.4%. Those are big changes. It may not sound like much, but at that level, it's a lot. And it implies expectations for a total of 100 basis points of cuts over the next 2 years, down from the 150 they'd expected before. So if any of you have heard finance people talking about something called a hawkish cut, that's exactly what this was. They cut rates. That's a dovish move, but they signaled, we think we're going to have more inflation in the future and fewer rate cuts in the future. And so that's a hawkish move. So it's being referred to as a hawkish cut. Concerns that rates and inflation would be higher than expected in 2025 and 2026. That's what took down the market in the middle of last week.
Gary, so what we're seeing is that there's indication that the Fed is not going to make any progress reducing inflation in 25. Obviously, as you mentioned, the market traded down. What does that mean for our portfolio? How are you looking at this? How are you positioning yourself?
Well, so you're asking the right question there because, first of all, it's amazing to me. We've talked for the last few months about how right after the Fed cut in September, every inflation metric, whether it's the CPI, the PPI, the PCE, they all started rising. That's not where you want to be if you're the Fed. And because they increased their inflation expectations for next year, they flat out said they expect to make no progress reducing inflation in 2025. So basically, they're saying we think there's going to be more inflation. Now, DKI subscribers are well positioned for that. I have been, uh, you know, very hawkish and of the opinion that no matter what happens, we're going to get a lot more inflation. So, the DKI portfolio is well positioned for that. We are loaded for more inflation. We anticipated this. And, as horrible as inflation is and as much difficulty as it extracts on people, we're expecting to make money from it. And it sounds terrible, but our subscribers losing money is not going to make anybody's price of eggs and milk go down.
Great stuff there, Gary. We'll keep eyes as we move into 25, and I have a feeling this will not be the last we hear about inflation or talking about inflation on the five things.